March 5th, 2024. We got a big leg one, leg two measured move today. From there to there, and it ended up being the low of the day. But I don't think it was really, these measured moves are important, but on days like this, it's a bear trend day, and you have to just kind of recognize that it's going to be a small pullback bear trend day. So these make better profit targets, places to take a piece off than they do places to just fully exit your trade or places to, fade the reversal. I think more likely when you start to see a bear, a small pullback bear trend day, you just find a way to get short at the market and make the market force you out above a bull bar. Bear bar, closing near its low on bar one. We had a big gap down, which not too surprising with the sell that started from yesterday. I think I mentioned on the weekly chart at the end of last week, I thought we were going to go above this high, but the bulls would be disappointed. And that looks like that's what's going to happen. So the question is starting to become for the bears, are they able to make the bar close on its low? Bad follow through on bar two, but do you want to buy above bar two? Probably not. It's a low probability reversal, and most likely we're just going to continue sideways. If you start to get big bull bars 3, 4, 5, then maybe you can start to buy, but low probability that ends up being some sort of low of the day, mainly because this gap down is so big, and so we're probably going to get the second leg down. And that was one of the reasons it was probably okay to take the short on 8, is that this gap probably needs a second leg down. And the whole move, this whole move started here, and the gap was part of it too. So the whole thing needs a second leg down, and this ends up being a two-legged correction. Follow through for the bulls on 3, but it's really not ideal. If you bought above 2, you wanted a huge bull bar on 3, and you didn't get it. So traders exit the market on the close of the bar, causing the micro gap down. And 4 closes on its low. Low 1 short on 3 for the bears. They're hoping for follow through, but they're probably not going to get it. This is probably going to form a trading range open, so most likely buyers below 2. Bears want follow through in 5, and you can see they get a doji. Inside bar on 6, it's a high 2, so it's a high 2 pattern on the open, but a doji bar. So maybe better to wait for follow through. And then a lot of times on bar 7, you get a surprise, and you get a huge surprise here on bar 7. And if you notice, if you buy above 6, you need the market to go 10.5 points above the high of 6 in order for you to make 10 points. Traders taking the buy, which was a reasonable high too, tried to scalp with 10 points and only went 10.25. So that means it was a 41 tick trap. When you get a 41 tick trap, traders will often start to panic out at the market as the market starts to come back down because they were 1 tick short and they're thinking, well, we're still somewhat close to my profit target. So they start exiting, causing this. And then traders see that and they just dump their longs since they have zero true risk. And that's how you get a big bear bar 8 closing near its low. Basically on its low. Do you sell below 8? I think you can. It's okay to wait for follow through too. These big bars after these big bull bars are kind of sketchy, I think. But after this big gap down, you probably need a second leg. So a reasonable swing short. Follow through on 9, but tails on the top and the bottom. So really not as good as it could be. More follow through on 10, still tails on the top and bottom. So it's not the strongest breakout in the world. But okay to be short, okay to sell. Follow through on 11, again, not the strongest. Tail on the top, tail on the bottom. Lots of tails. You still have an open gap with the 9 low and the 11 high right here. And additionally, you have an open body gap pretty much with this breakout point. And we, if you look on the, easier to see on the line chart, but basically what ended up being this and all the way down here. But right now you just see an open gap with here. And you had the open gap with yesterday's low, right? So when you have an open gap with the prior day, the prior day's low, that counts as one of the 2 open gaps you might need to see a potential bear trend day. And then getting the open body gap, which lasted basically to here. Follow through on 11. My one thought about this is, well, 2 things. Usually when you get this strong of a spike on the open, it's too climactic to last all day, right? We're not going to fall like this all day and keep getting further and further away from the moving average. That would be insanely rare. So we're probably going to pull back relatively soon. My other thought is after you start to pull back, you'll probably end up getting a measured move down based on the height of the 4 bars. And that's what we got. If you used the full height of like technically the selling started up here. So maybe if you used all of the height, you get closer to the low. But the reality is I would personally, if I was going to go for a measured move based off of the height of these bars, I would just use the clearest piece of the spike. But again, it's a place to potentially take profits because it can be a support area. It's not a place to look to fade or reversal. You should mostly only be selling on this day. There's a couple exceptions in here. So 12 pullback, 13 a bear bar, but a tail on the bottom. 14 some follow through for the bears, but this really isn't all that good. It's a couple legs down, so I think we're going to pull back towards the moving average pretty soon. 15 sellers above 14, scaling it higher, and then outside down 16, closing on its low. But how much lower do you think we're really going to go here? You think that 17 is going to be a giant follow through bar closing somewhere down here, putting us this far away from the moving average? Probably not. That'd be really unusual. So you get disappointment 17 and a bull bar 18. 17 went up, pulled back, and then bull bar on 18. So it's a two-legged correction, 17 and 18 on a smaller time frame. Towards the top of this, we should touch at least the high of 16 since it was the most recent sell climax. You can see that we did. And the 12 close, which is essentially where the trading range started. You can see that's for the high of what we touched. 19, a bear bar, closing kind of near its low, but not really all that good. And 20, another leg up for the bulls. So it could be two legs up like that. 21 tries to trade below, or trades below 20, but it's a low one short, low in what's probably a developing trading range, really not all that good. 22, a bull bar closing near its high. I think this is the kind of trade that you got to learn how to weed out. These trades look good, but they're really not. You're buying at the top of a tight trading range, 18, 19, 20, 21, tight trading range, and 22 is buying the top of that tight trading range. And, so it's really not all that ideal. And if you're buying above 22, 23 isn't really even what you want to see. 23 just might make me give it the trade one more bar. If I'm buying above 22, I want to see a bar like 30. I just want to see us rocket up basically and race up to somewhere in here. And if that's going to happen, I'd much rather just wait to see that bar because it's low probability. 23 has a big tail on the bottom. It creates big true risk for you. So I think if you're going to buy above that, you got to have a wide stop, maybe the height of the trading range somewhere down here, and be looking to buy more lower. But you can't buy above 22 and then just exit below 26 and not take the sell or just take the loss. You know what I mean? Because these are the better trades, like selling below 25. Selling below 46. These are much better trades than stuff like this. So you have to, on this small pullback throughout trend day, when it could be that with the open gaps and we've been below the moving average so far all day, you just kind of have to be mainly looking to sell and try to avoid buying as much as possible. Because a lot of times you get stuck on these days trying to catch reversals that either never end up coming. You sit here the whole time looking for a bull bar and it never comes, or you end up trying to force a trade and then you end up getting stopped out. So follow through on 23, but it's not that good. Maybe you give it one more bar, and when you get a doji on 24, a lot of traders just start to exit, and that's why you get a tail on 25. 26 closing near its low, potentially dropping the bulls who bought below 25. But my problem with this is we have not touched the moving average yet. So it's an okay sell below 26, but not touching the moving average yet is a problem. And then we got a huge bar on 27. And if you're sitting there and you sold 26 and 27 somewhere down here, you have a decent open profit. And you know that, if 27 closed on its low, are we really just going to vacuum straight down? Probably not. It's unlikely. So, especially considering how much we've sold off so far today, we probably need to go sideways. So a lot of traders start to exit, and that causes the bounce on 27, inside bar 28, inside bar 29. So we have an II, and when you get an II after a sell climax, it's a buy above. So it'd be a buy above 29, reasonable swing. And if you look, you can see that the traders who bought above 29 ended up making almost exactly 10 points. So those traders ended up scalping out with 10 points rather than, these traders who failed to make their 10 points. So 30, a big bull bar closing near its high. You can see we failed to break out below the II on 29 and then got a reversal up and broke out of the high. Seeing the failed breakout is also good because it could trap some bears in. Bears have to exit above 30. If I was a bear, I would have gotten out above 29 as we traded above during 30 and potentially bought. That's what I did. I sold 26 today and I exited a piece pretty much near this low. You eventually start to look at these things and you'll start to think about that real time, and you're 2.5 minutes into the bar and it's down here and it's like, how big is this bar really going to get? But it just takes time. So I exited the rest up here and bought above, and I added above 30 on 31. Sorry, I didn't add above 30. I added up here. But anyways, doesn't matter what I did today. Objectively, good buy above 30. You're probably getting back to the most recent sell climax high, maybe the 26 high, maybe the 25 low. So you get some follow through on 31 for the bulls, more follow through on 32. 3 straight bull bars getting to the moving average. But what's the problem? You're going to have traders selling at the market when we touch the moving average because we haven't touched it yet today. So first time touching the moving average today, probably going to find some sellers, which we do, 33. Sometimes when you get an II after a sell climax, the market will just kind of drift up for the rest of the day and, probably at least reach some magnet like this low. You could also argue this is a failed breakout of the 18-bar range. So the bulls had a lot going for them, but they needed to start to get a strong breakout above. And you can see we've got a pullback 34, a good bull bar closing near its high 35, but the follow through on 36 is not ideal. You get a bear bar closing near its low 37. I wouldn't sell it. We have 7 straight bull or 7 bar bull bar micro channel. So I would not sell below 37. Probably buyers not too far below, but okay to exit longs. Follow through 38. I still wouldn't sell. I think we're going to get another leg up because this channel was pretty tight. 39, a bull bar closing near its high, but right on the moving average. I'd rather wait and see the follow through. Bulls, I think, are looking to buy to start that channel, and bears want to make it fail, and then they can take a sell for a swing. So some bulls are holding long, waiting for the market to really force them out. Bear bar closing near its low 40. I would be flat at this point. We're starting to oscillate in this range, and what's either going to happen is you're going to start to get a breakout to the upside, or we're going to drift up the rest of the day, or we're going to get a breakout to the downside and get a reversal down. We could go sideways for the rest of the day too, but I thought that we were probably going to get another breakout today. I was just waiting to see which direction. Follow through on 43, but it's not that good. And then you get a bull bar closing near its high 44, above the moving average, but in the middle of a tight trading range. So I'd rather wait for the follow through rather than buy above 44. But this was the opportunity that bulls were looking for. They wanted to see a good bull bar closing near its high, and they wanted to start to get the drift up right here. And they got disappointing follow through on 45 and exited, and that caused a big bear bar closing near its low 46. The bulls should not have allowed this to happen. If we were going to go up all day, this was relatively okay, but I thought we need to go up pretty soon. But they definitely should not have allowed 46 to happen. And because 46 happened and closed near its low, bulls are going to exit thinking that we might get a big leg one pullback, sellers at the EMA, and then a big leg two. And you can see the follow through on 47. Why did it stall? Well, the bears who sold above 29, above the II, betting the breakout was going to fail, were obviously disappointed. And they scaled in, and they have a chance to get out here around break even. So the problem with selling 46 is you're selling right on the support point. But I think it's still a reasonable swing sell. Disappointment on 47, bull bar 48, 49, but it looks like a couple legs up. Bulls wanted, a couple strong bull bars closing near their highs here. And if they got them, they were hoping that we were going to start to get that measured move up to somewhere in here. But instead we get disappointment 49, disappointment 48. And so what's more likely is the bulls who front ran the whole thing are disappointed and they're going to sell it at a long. And that's what causes 50 closing near its low. You can sell below 50, follow through 51. A doji bar 52, and then an outside bar 53. So inside bar, outside bar, breakout mode. Bear bar closing near its low 54. It's a low one, but you have to keep in mind you're probably going to sit through a pretty deep pullback if you're going to sell this. So I probably have a wider stop than above here, since you need to close below this low to technically have a stop above here. 55, bull bar, but not really all that good. Outside bar 56. I would just, I was personally short in here, and I put a stop above here, and I did get the stop run during 58, and I just sold again below 58 because it was a bear bar closing near its low. I thought it was kind of hard to sit short through all of this. It was probably minor, but if you do exit for any reason, you just sell again below a bear bar closing near its low 58 or 61. So 57, a bear bar closing somewhat near its low, but see it doesn't trigger, and then 58, a bear bar closing kind of near its low. It's mostly a doji, but still a bear close well below its midpoint. So an okay swing sell. And additionally, we're at the moving average. The bears sold the moving average. They sold the moving average. They sold the moving average. So you can see here they're selling the moving average again. So we might get another leg down. Disappointing follow through 59. It's a lower probability sell below 58. It's a swing short. And then an inside bar on 60. And we end up getting a collapse below 61. Doji 62, follow through 63, 64. I would personally probably just get out above 67. We're getting pretty oversold here, so I would just get out. You can sell again below 68, and I would probably just get out above 70 and then be done. We do get a buy the close rally at the end of the day, and I probably wouldn't buy until 76. I probably wouldn't buy at all because it's so late in the day. You can see bulls were more interested in buying the 50% pullback of 76 than they were buying directly above it. But we ended up getting a rally, so it was okay to buy any of these. If you look on the daily chart, I think that had a lot to do with the rally at the end of the day. We had a pretty strong close so far, and this was a bad signal bar. So I think we'll probably get back to this low within the next couple of days. But this was a good job by the bears. I think we're in a trading, we're probably starting to form some kind of trading range. We might have already been for a while. The trading range bottom could be somewhere down here around 5,000. That wouldn't surprise me. But the bears overall did a decent job. Tomorrow, I'd expect a couple hours of sideways to up trading because of this rally, and because after a bear trend day, you usually get that. I think that if we do get a gap down tomorrow, you might end up seeing some sort of swing. And on the weekly chart, we ended up testing this week's high, or this past week, or a couple weeks ago. The February 12th high. So they sold here, they sold more higher, and they made money. So bears are officially making money. in this bull trend on the weekly chart. So probably going to start to go more sideways soon. I'll be interested to see if we're able to get back up towards a new high without selling off. For stop orders, probably 8 was okay, 10, 11, 25, buying above 29 or 30, 32, 46, 49, 51, or sorry, 50, 51, 58, 61. Like I said, 54, but a wide stop. 63, you could have sold any of these closes and just get out somewhere in here, and you could have bought 76. But yeah, these are the kind of days you want to start trying to make money on. If you're newer, like the small pullback days are really hard to, but for always in, they're the best days. So yeah, that's the day.